Bitcoin's pulled back, and they're like, why the hell is it pulled back when Trump's announcing strategic reserves, repealing SARB? There's all these things that are like super bullish. It's pulling back, and it's because the S&P's diving in price, and it's highly correlated. And we didn't pull back as hard as the S&P because that pulled back to to like June last year or some price, May or June last year, that price levels, and we haven't pulled back that far in Bitcoin. If we want to get to exceeding gold's market cap, we need roughly 10% of world equity valuation going into Bitcoin, or we need 1/10 of world GDP going into Bitcoin. Do you think that's going to happen?
Just when you'd expect Bitcoin to surge, especially after Trump's pro-crypto strategic reserves announcement and a wave of bullish news, it's doing the opposite. Why? Because Bitcoin remains stubbornly tied to the S&P 500. When traditional markets tumble, crypto often gets pulled down too. But here's where things get interesting. Bitcoin isn't falling as sharply. While the S&P 500 has dropped to levels not seen since mid-2023, Bitcoin's dip has been relatively shallow. That hints at underlying strength amid all the market chaos. Analyst Willy helps put things into perspective. For Bitcoin to truly rival gold as the world's premier store of value, it would need to capture around 10% of global equity valuations, basically a tenth of the world's GDP. That sounds like a moonshot. But then again, Bitcoin has shattered expectations before. Right now, the market feels like it's in a tug of war between macroeconomic headwinds and crypto's long-term promise. According to Wu, the real question isn't just why Bitcoin is dipping, it's whether this is the calm before a massive rally. So keep your eyes on the charts. This might just be the dip that turns into the launchpad for the next big move. Now, let's check out some explosive insights from Willy Woo's recent interview. And as always, don't forget to like, subscribe, and hit the notification bell for more deep dive content. Thanks for tuning in. Let's dive in.
I would say within crypto markets today, there is probably north of $10 billion of US dollars that is in there looking for yields. It could be 20 billion, but I think it's about, at least in the hedge fund world, there's $10 billion being put to work as my estimation to get yield on US dollars. And the way it looks is that this money is being lent into, and the lenders are kind of more crypto native lenders, and they're lending their liquidity into prime brokers who are then lending it to hedge funds so they can leverage up their arbitrage trades. There's $10 billion of capital in there. If you're doing that, you're getting, I think that the PBs will be getting, those guys probably getting 10 to 14%. I don't know for sure because it's all kind of dark pooled money, but it's roughly that. And then the hedge funds are getting anything from 10% if you're a shitty hedge fund, 50% annualized if you're a good hedge fund. As in you really know how to get the alpha in the trades. So they're happy to borrow at 10-12% if they're going to make, say, 30% in their trades. So anyway, all of that to say let's say there's $10 billion of money that's being lent into the space, and then Cantor Fitzgerald's allocated $1 billion. Well, the interest rates ain't going to drop by much. But say $10 billion comes in, then that's going to make a difference. And say $100 billion comes in, and then, whoa, the rate's going to plummet because they're all going to be a race down to the risk-free rate of US dollars. So it'll take, some time, maybe, 18 months. Like this next generation of lending products will be absolutely, the DeFi way, that infrastructure will be, and I believe will be used by banks, and also banks will use, institutional grade custody to hold, and they have to abide by the regulations of custodians and banks, and so it's different. It's become TradFi levels of disclosure. We've been told TradFi is really bad after 2008, but actually, as we've seen, crypto is worse. Actually, there's a lot of crypto that poses to be, decentralized, but it's not. It's unregulated entities behind it doing whatever they want. There's not even regulations. What happened in 2008 was a dismantling of very good regulations so that people, bad actors could make a lot of money as those regulations got dismantled. And so, but this, custody, is pretty tight. So anyway, I think that the 2022, certainly with Bitcoin, it's not going to happen. We've got multi-sig, and TradFi's, going to come in a rush to lend. Well, if the rates are like, first the rates are like 12-14% right now, and they're happy to lend at that because right now they're lending at 6%, and then after that they're going to be happy to lend because it's such great collateral for them to liquidate you.
Bitcoin-backed loans are lower risk when used to buy a property that also acts as a collateral, because you've got the benefits of both.
Yeah, you use your Bitcoin appreciation, but basically you're shorting fiat in a non-gambling way, where not like putting in an exchange. You're fronting collateral to borrow dollars to buy assets that are appreciating against fiat, which is going down. So you're basically shorting fiat. You're buying something that's going up against fiat. If you're really wanting to do a interesting Bitcoin product, to buy a house, and so you're going to have a lot of Bitcoin, therefore you're going to be a qualified investor, then they would be eligible to buy into a hedge fund. Now, hedge funds are compliant to all manner of regulations, and they have do a hedge fund. This was all worked out in the 90s, right? When hedge funds, like the days of Madoff and all this. There's all right. Number one, the accounting. The accounting is done by a third-party fund administrator. They are overseeing every single trade that the hedge fund is doing, so that the reporting comes from someone else. And then every year you get an audit over everything. And then the whole thing is open to due diligence. You can send an ODD provider, operation due diligence provider. You can go through a fine-tooth comb of how every single thing is done. How do you value these assets? Who has the keys or signatures, the bank accounts? Who are the independent directors? Which jurisdictions? You can just go down, all the ways in which, through malice or incompetence, this hedge fund can lose money. And that is you can fully diligence a hedge fund like that. And it's not like you can go to BlockFi and say, I send a guy in and I'm going to see all your operations. I want to see you don't do that, right? So there's all this regulations around these hedge funds. And so the thing is, we run hedge funds that generate yield, right? And the trade is arbitrage, right? It's like mispricing the market. You take that one trade and you make a tiny fraction of a percent, but you do that over enough minutes of the year, and then adds up to a 30% yield or whatever, or a 10% yield. For Bitcoin, you should be able to get a pretty much 10% yield annually doing that trade. You wrap that into, hedge fund is a share. You buy a share in a hedge fund. It's an equity. Now the trick is, can you make that equity collateral with a bank? If you achieve that, then you're basically buying Bitcoin shares. Now you're a Bitcoin OG or maxi hodler, and you say, I don't want to ever give my keys out. But if you're going to borrow money, you're basically signing off your house to the bank. They can take claim of it. So if you actually want to borrow money, you would then sign it off to the bank and let the bank custody the shares in this hedge fund, which is now generating 10% return. And then you're borrowing, Lombard loan rates are around 6%. You're borrowing at 6%. And the LTV of maybe 3 to 1. For every, so say you got $1 million that you want to borrow, you have to front $3 million of Bitcoin. You're making 10%, so you're making 300,000 per year of gains in the yield of that in your security, which they have as collateral, and you've got to pay an interest rate of 6% on 1 million, so 60,000. $60,000 is your interest bill, and you're making 300,000 per year. This is putting your Bitcoin to work. Work it all out, 3 to 4 years, that $1 million, you bought a house with it, is paid by your Bitcoin.
A tidal wave of institutional capital is pouring into crypto. And this time, it's not chaotic DeFi yield chasing. It's structured, audited, and regulated. Hedge funds are deploying billions into arbitrage trades, pulling in annualized returns north of 30%. Lending desks, prime brokers, and TradFi custodians are quietly building a new backbone for the digital asset economy. We're watching Bitcoin evolve before our eyes, from speculative instrument to productive collateral. Investors are using BTC to acquire real-world assets like real estate, earning yield while effectively shorting fiat in a structured, risk-managed way. This isn't gambling, it's strategy. Wrapped inside hedge fund structures, backed by third-party audits and subject to institutional-grade due diligence, Bitcoin is stepping into a new financial role. Lombard loans with favorable loan-to-value ratios and 10% yields are turning hodlers into active participants in a maturing ecosystem. And when the banks fully step in, rates will compress, but legitimacy will be cemented. Still, this transformation brings real risks. Quantum computing, regulatory gaps, coding vulnerabilities, and centralized choke points still threaten the system. Developers are scrambling to future-proof infrastructure, and altcoins are feeling the squeeze. Ethereum and Cosmos may be showing strength, but their long-term roles remain uncertain. Apps or protocols? The market hasn't decided. Bitcoin, on the other hand, is decoupling, subtly. It's pulling back less than the S&P 500 despite macro turbulence. That divergence could signal a deeper shift. Institutional confidence may be growing, with 19 straight days of inflows into BlackRock's spot ETF. The smart money is clearly watching. But here's the challenge. To rival gold, Bitcoin needs to capture 10% of global equity value, or 10% of world GDP. A bold ask, no doubt. But then again, Bitcoin has never played by the rules. As we approach critical resistance levels, volatility remains close. A breakout could spark a run to $130,000. A breakdown might see us retest $88,962. Altcoins are dancing on their own ledges. The next move could define this cycle. So, what do you think? Can Bitcoin reach that 10% milestone? Or is this ceiling unbreakable? Drop your thoughts in the comments. Like, share, and make sure you're subscribed with notifications on.